The S&P 500 has reached 24 new all-time highs this year. Earnings have grown more than 20%, and several global asset classes have posted double-digit gains. Despite plenty of unsettling headlines, the first half of 2026 delivered broad market strength. So what drove the gains, and what should investors be watching in the second half of the year? Hello, I'm Eric Pettway, Chief Investment Officer, Journey Advisor Group. Welcome to CIO Corner. Last week, the S&P 500 gained 1.3% and the NASDAQ 100 rose 1.8%. The S&P 500 is now up 11.3% for 2026. Developed international markets underperformed last week but remain ahead of U.S. equities for the year. Second quarter earnings season begins this week. FactSet forecast year-over-year S&P 500 earnings growth of 23.6%. If confirmed, that would be the second straight quarter above 20%. Now for our chart of the week. This chart compares the current U.S. business cycle with previous cycles since World War II, looking at both duration and real GDP growth from the previous cycle peak. The current business cycle is now in its seventh year and remains strong. The economy has stayed resilient through inflation, tariffs, and recession concerns. Payroll growth is averaging 11,000 jobs per month, above the long-term average. Consumer spending has held up. AI-related business investment has accelerated, and the dollar has stabilized. Higher energy prices remain an inflation concern. While the peace deal framework and ceasefire with Iran remain tentative, oil prices have moved back toward pre-conflict levels, suggesting inflation may be near its high point for this cycle. The key takeaway is that every business cycle follows a different path, but the current expansion has lasted longer than many investors expected. That economic resilience has also helped support markets. In the first half, the S&P 500 returned 9.6%, the NASDAQ gained 12.8%, and the Dow rose 8.9%. The second quarter was especially strong, with the S&P 500 returning 14.9% as the market rebound began at the end of March. Performance also broadened. Emerging markets stock gained 22.7%, small cap equities rose nearly as much, and commodities climbed 12.3%. Corporate earnings have supported returns, growing more than 20% over the past 12 months. Valuations are elevated, with the S&P 500 trading near 20 times forward earnings, compared with a long-term average of 16 times. Bonds also remain attractive. The Bloomberg U.S. Aggregate Bond Index yields approximately 4.7%, above its 3% average since 2009. Investor-grade corporate bonds yield 5.1%. Volatility will continue. The war in Iran remains ongoing. Investors will match the Fed, and the November midterm elections will draw attention. But earnings, economic fundamentals, and the business cycle remain the primary driver of markets. Artificial intelligence is another major theme. Large technology companies continue investing heavily in AI infrastructure, and high-profile IPOs, including OpenAI and Anthropic, are anticipated later this year. The bottom line is that the first half of 2026 rewarded investors who stayed diversified, remained invested, and focused on the long term. As we move into the second half of the year, remember that a well-designed, diversified portfolio is built to navigate environments like this. Follow Journey Advisor Group for more market perspective, and connect with your JAG team if you have questions about your portfolio or strategy. As always, remain calm, stay focused, and most importantly, stay the course.